that we're talking about financial options, not real options. Anything in the derivative market must start with anything in the derivative market must start with a belief. What does it start with, guys? Stay with me because it's going to get a little bit complicated. Belief. Anything in the derivative market must start with a belief. So two people, they have the opposite belief. This guy is bullish. This guy is bearish. What does bullish mean? He believes the market is going to go up. What does bearish mean? He believes the market is going to go down. Because they both have the opposite belief, they can be engaged in the derivative market. They cannot have the same belief, because if they have the same belief, they cannot have a party and a counter party, right? It has to have the opposite belief. Okay? So this is the first condition. And if this guy is bullish, usually he will be long. Long means he's a buyer. And this guy would be short. And short means he's a seller. In the derivatives, this is usually the situation. The buyer is long, the short is seller. The buyer is long, and the short is seller. And this is bullish and this is bearish. Now, the exception is the option market. So in the future market and in the forward market, this belief holds. The buyer is bullish, the seller is bearish. In the option market, it can actually have the opposite. You could be bullish or bearish and sit on either side of the transaction. And this is one of the first attributes of options. You get that? In the forward, in the futures market, it's either bearish or bullish. Usually the bullish is the buyer and the bearish is the seller. In the option market, could be either or. And this is just one unique thing about the option. Okay? Now, yeah.
So like in the options market, you could be bullish and be a seller.
Right, you could be a bullish and be a seller. And can I explain? Right? Right. Very only an attribute of the options, right? Other derivatives, no. Only an option. Okay. Other phenomenon is we already watch and we see the report. There is 23.3 million contract on a CME on a daily basis. Right? From the report. How many? 23.3 million contract. Which means on an every given day, there's 23 million people. They have one belief, and on the other side of them, there's a 23 million people. They have the opposite belief. With me, guys? Okay. So every day, people, about 46 million people, institution, just on the CME belief, they have the opposite belief. And that tells us already that the issue is not settled. Because if everyone knows the directional of the market, you wouldn't have this opposite belief every day. Right? You will have the same belief. Nobody wants to lose. Okay? What drives that? What drives this phenomenon? Every day it repeats itself. Here is what drives it. And you're going to say, what the hell is that, Professor? This is what they call it in our language, in the derivatives, is a random walk. And you need to know that. Random walk. random walk, or in a different story, it's the Brownian Brownian motion. Brownian motion. Now, random walk, it's a really reference in a discrete movement. And we're going to talk about it later. The Brownian motion is referencing a continuous changes, not discrete, it's in a continuous basis. These two phenomenon, one is going to be used when we're going to price options, not today, in the future, how you price a call and how you price a put. Here, on the random walk, we're going to use that concept in the binomial model. And here, we're going to use the Brownian motion in the Black-Scholes model. I'm just throwing things into your frame of reference, right? Today, we're not expanding on it. Just know these two terminologies, so when we get to them, it wouldn't be the first time you heard them. Either way, both of them are Markov properties. Both of them is Markov property. And again, a Markov property, guys, in a simple way, it means each time the stock price move, it does not depend on the previous price. Okay? Each time the stock price move, it does not depend on the previous price. One more time. It's the Brownian motion that caused the phenomenon that we don't know what the hell is the stock price is going to be. It's the random walk. And they both are derived from the Markov property that we're going to be using to price options later on in the class. Okay, I just threw this at you so you can have them there and we'll discuss it later. Okay, so what drives the market that every given day there's 23.3 million contract on the CME alone, and there is the opposite belief, and this is repeated itself every given day. Okay, because of this, nobody knows what is the direction of it is going to be. Okay, so now you cannot challenge later on what I'm going to tell you why these guys are bearish and why these guys are bullish. You cannot challenge that anymore because we already see it repeat over and over 23 million daily contract, right? So we're not investigating at this moment what drive their belief, but we agree they must have a belief on one direction. You with me? They must have started with a directional belief. To be here or to be there, it has to have a directional belief. Okay? Now, let's talk about, and we're going to start with what the question you raised. Can it actually be the opposite? Can the opposite, the seller, the buyer, be bearish and the seller be bullish? Right? That's the question you raised. So we're going to start from there. So this guy, his belief is bearish. This guy believed is bullish. And this is going to be put. So I'm introducing you to put first. Put options. And as I told you the story before I go into terminology, put option is an insurance. It's a hedge. So when you have a put, you're really trying, this guy is going to want to hedge his risk. I told you, you can actually have it in the you can have it in as a hedge, or you can have it as a speculation. So he wants to hedge. Okay. Before I tell you what he's going to do, you guys have cars. You all drive cars, right? And your car, we can assume that you are the car owner, right? You are the car owner. You have a car. The car has a value. And you worry that you may enter into a car accident. And you want to have coverages to replace the damages you may encounter. So what do? You go to Geico Insurance, and you say, I want to buy a car insurance, right? And Geico say, okay, I'm going to write an insurance on your car. So if something happened, I will pay you. You with me so far? Okay. So an auto insurance is really a put option. Because one guy is afraid and have risk. And one guy, after they did the research and study, they say, based on your age, your driver record, your car you're driving, we're going to charge you this much premium. And they not worry because they did a lot of research and they have other model, right? But you are worried. And for the concept we're using here on the car insurance, you will have a premium, right? They're going to charge you how much? You will have a limit. We're going to cover it for a year or 3 months or 6 months, right? So here is a similar story. This guy he owns the stocks. He owns what? Stocks. He doesn't own cars. And he worried the price of his stocks, it may go down because how the market move, it might drop. So assuming again, this is the story. This guy knows the market move like this every day. You agree with me? Right? And he's right here. Today, he's right here. And he have 100 shares. Let's write it there, 100 shares. And the share price is 150. Here is the share price is $150. And he doesn't know what's going to happen. And he wants to hedge his risk. So what he's going to do, he is going to go to this guy who has the opposite belief that he's not worried the market is going to go down. And he's going to ask him, can you write a put for me? Can you sell me a put? Because this guy's going to be the seller. And in another language, he is the writer. This guy is the buyer. Okay, so this guy have 100 shares. The share price is 150. So his holding is worth $15,000. His girlfriend or his wife is really more risk averse than him and tell him, honey, we cannot lose any of this money. And we need to protect it for the next 3 months because we're going to use it to buy a house. So he bought the share here somewhere, and it went up in value, and he's happy with that, and he does not want to risk it. So he's going to enter a contract with this guy. All right, it'd be a little bit this way. He's going to enter a contract with this guy, and he's going to tell him within 3 months, anytime the price goes down to, is here, 150, he said to him, anytime, if the price goes down to 140, you promise to buy my share at 140. You promise to buy my share at 140. So what is a put? A put is a financial instrument, give the holder the right to sell at a specific price. to sell at a specific price. We call it the strike price. What do we call it, guys? The strike price, K. So K is the strike price. So here, this guy entered into a contract with this guy that he will buy from him at 140 anytime within 3 months. And he has the right. So he can exercise anytime within 3 months, sell it to him for 140. Okay, the time went by, and it went through a random walk, and the price, one of the possibility, the price may rise to 180. The price is going to rise. This is the first possibility. Okay, I didn't tell you how much premium he paid. So he has to pay this guy a premium, like the car premium. He paid this guy $5 per share, and that means he paid him $500 in total to have this option, right? It has to come at a cost. We call it what? Premium. Okay, so this guy entered a contract. This guy is bearish. He believes and he's afraid the market is going to go down, and he's here want to hedge. Keep in mind, if he does not own the underlying assets or the underlying security, he's going to be naked. Here, he's not naked. He actually owns the security, right? And we want to hedge that price. So this guy entered an agreement with this guy. He paid him $500, and now he has an option. The market, there's two possibilities. The market went up to 180. Within 3 months, the market keep rising. Today's at 180. He's not going to exercise, right? Because the market actually did very well. Why would he sell it for 140 and he can go sell it for 180? So he's not going to exercise. He's not going to sell it to the guy at 140. So how much money did this guy make in this transaction? The price went to 180, and now the time come, and his wife told him, you need to sell, so we're going to buy a house. So he made $30 extra per share, and he has 100 shares, then he ended up making a profit of $3,000. But here, he paid $500 for this guy for the option, then his net gain is $2,500. It's like a car insurance. You buy an insurance, nothing happened with you, you did not have a car accident, but you lost the cost of the premium. You with me? Second possibility. His expectation was right. The market went through a random walk, and within 3 months, things keep getting worse and worse. And I need to rub here so that my graph looks decent, and the price dropped to $100. Here at $100, and here is the 3 months. So what will happen? He's panicking, right? If he did not have the put, he would have lost how much? $5,000. You guys with me? You're following the story. He would have lost $5,000. Why? Because you have 100 shares, and the new price now is 100 from 150. Then he would have lost, without the option, he would have lost $5,000. With the option, this is break out. I'm going to give you something typed and good, guys, so don't worry. I just want you to follow the story. Without the option, here it sounds smooshed together. So here is without. He would have lost $5,000. That was the option. When the price went to 100, he went knocking on the door of the other guy and said, hey, by the way, you remember we have an agreement that you will buy from me at 140 at any time. Are you good, dude? This is your shares. Give me 140. So the guy's going to say, yes, I know, I will have the right. So by doing that, he's going to sell it for how much to this guy? He's going to sell it to him for how much, guys? 140. Stay with the story, guys. It's a story, right? The guy had a put option, and the put option gave him the right to sell at a specific price. And we call that the exercise price or the strike price. How much in our agreement is turned? 140. So although the price is at 100, it doesn't care. It's gonna sell to this guy at 140. You with me, Muhammad? You know, you good?
Yes.
Okay. So it's gonna sell it to him at 140. And in this case, he only lost 10 times 100, $1,000. So he lost $1,000 on the shares price, and he lost $500 or cost on the cost of the put. So his losses is $1,500 versus 5,000. Here for the example is 1,500 and 5,000. In real life could be 50,000, 50 million, 50 billion.
So the holder has the right to sell, but the buyer, does he have an obligation to buy?
Yeah, this guy, the writer,
Yeah,
he must buy. Keep in mind, in real life, these guys, they don't know anything about each other. This is an exchange traded derivative. This is by the exchange. They're not gonna know anything about, they don't know who that guy is or who that guy is, right? And the exchange has never defaulted so far. As long as they do it within the 3 months and they do it, then they're fine. Okay, in this case, it's a cover call. In many cases, it's not. In fact, when we talk about speculation, they don't have to. And just for your question, because your question raised an important part, how does the margin work? How does the margin work in the option place? You have a question or you good?
no,
The premium, that $500, is that like throughout the 3 month?
Right, it's like a car insurance. I'm gonna insure your car for a year. This guy said, okay, you have the right, but it's not forever. Only for 3 months, for 1 month, because they trade all the time for 6 months. Depend on here for the story, 3 months.
So 500 is just for the year.
That's it. It's kind of like a premium for that period. And there is a whole story behind the how far is it? Is it in the money, out of the money, time decay? We're just building the story. The Greeks, I'm not gonna talk about the Greeks now, but they can play a big role in the game option. Okay. So you following the story. So here the put option play as a hedge for someone have a risk and transform his risk to this guy in the event that this is happening. Why they enter into this from the beginning with? Because they have the opposite belief, right? This guy believed in this direction and this guy believed in this direction. So don't question the belief again, right? Why you have a car insurance? Because they already did the study. They already know that maybe some would fail, some would have an accident, the other don't, right? These guys, they have the opposite belief. How many of them every day? How many? 23 million every day. Okay. Any questions so far? So now, in the definition, a put is a financial instrument that give the holder, which is this guy, the holder, the right, not the obligation, the right, not the obligation, and this is the magic word, to sell at a specific price. Because later on the call, we're gonna say, give them the right to buy. Here is to sell. You want to imagine like he's gonna shove it down his throat for 140, although it's traded for 100. We're good, gentlemen, there? Any question? This is a put option. And this is a hedge. Okay. Really, by the end of this class, you'll have to find names for these two dudes.
A and B.
We need to find more creative names. I know you guys think of it. Okay. Now, we can do calls. And calls, we're gonna do it in a form of speculation. The first one was a hedge. You have an assets you want to protect. By the way, guys, the previous story I told you about the put. Who did the put in the previous class when I introduced you to the story about Warren Buffett? Warren Buffett did a put on the indexes, and how much money he made? $4.9 billion from the put. So Warren Buffett was the head, but he was the writer. And he got premium 4.9 billion. That was a big, right? You guys with me? And how come? Why? So was he bullish or bearish?
Bearish.
Think again. Bullish. Either bullish or bearish, right? But he was bullish because when he wrote the book, on the indexes, between 2004 and 2000, I think 2007 or 8, I forget the year exactly. He was writing a put to someone on the other side that was bearish, that he was thinking the indexes is going to go down. Therefore, they were willing to pay him $4.8 billion so he can ensure if the market moved down, he's going to pay them. In the previous lecture, this was part of the slides, right? I didn't see the specification of the trade, but there was write up on it that he made $4.9 billion, and he was a writer. Why? He could choose another strategy, because if he's bullish, here he was bullish as a writer. He could actually, he could also be a bullish and here. But in this case, he would have to be long and buy. Because on the call option, if you are long, if you are the buyer, you are bullish. On the put, if you are the writer or your seller, you are bullish. So he could have actually, why did he choose to be here and not to be here? Because to be here, you have to pay a premium. In his position, he's the one who received the premium. And to receive a premium and to invest it is a lot better than, in fact, we call it, he has a net positive, not a net loss, right? And he was making money out of his name. Because if you remember in his words, he said, someone at the end of the contract has to do something painful, write a check to the other party. And because he has his name and he's honorable and people think he's not going to default, they were willing to pay him $4 billion, $4.9 billion. But in case of the index went down, right, because they were afraid it's going to go down, he will pay them. So that's, you think about why you choose to be there, right? Let's go back again to calls. So this is a practical application and everything, not just a classroom discussion. Here, and a bullish, the long, which is the buyer, has the bullish belief. He believes the market is going to go up. This guy, the seller, or the writer, has a bearish belief. He believes the market is going to go down. Okay? So this guy will buy, this guy would sell. This guy is a speculator. Okay? He has new shares. He does not own any shares. And he thinks Apple stock is going to go up. What do you think, guys? We're just going to talk about apples. He watching the market and he think Apple stocks is going to go up. So he's right here, and nobody knows what's going to happen, right? It could go either way. Because this guy, he agrees, this guy might think it's going to go the other way. He's hoping it's going to go this way, up. So he's going to, I'm going to use the same example. It was traded for $150. This is how much it's traded for today, right? Then he's going to say to this guy, well, if the share price went to 160 I want to have the right to buy it at 160. Doesn't matter what is the share price is. I want to have the right to buy it at 160. Keep in mind, guys, no one of them, they are here today. No one knows for sure which direction the market is going. Yes? Today is at 150. It could go either way. Random walk. But he said to him, I want to pay you, and I'm going to pay you, let's use the same example. I'm going to pay you $500 to have the right to buy the share at 160. Doesn't matter what is the price is. So the holder of the option, the buyer of the call option, has the right to buy. You guys with me? Has the right to buy at a specific price. We call it strike price within that period of time. Another story, he has the right to sell. This guy has the right to buy. Remember that, because when you start talking about a strategy, you're not going to know who's buying and who's selling, right? Just keep that in your mindset. Okay, so he said, well, share price is at 150. So he's going to give this guy $500 and he owns 100 shares. He doesn't own any shares. He's just going to buy one contract. He's going to buy one contract. In the option, a contract is 100 shares. Guys, you know that? In the options, each contract is 100 shares. So he's going to buy one contract, which is 100 shares, right? And can I give him, and can I let him control 100 shares? So he said, sell me one contract for $500. If the price move to 160, I have the right to buy it. Okay? And he said, for how long you want to do that? He said, for 1 month. So this guy said, okay, 1 month is not too long. I can live with that. You guys with me so far?
Only 100 shares or?
No, he doesn't own them. Oh, this guy?
Yeah.
This guy doesn't own anything.
He owns a contract.
Yeah, this guy have two options. First option, he's gonna buy a call option, but he actually can go and buy the shares. And we're gonna talk about if he buy the share, what will happen. He doesn't own anything. So Muhammad, he want to buy this share. Each share is 150. If you want to buy the shares, how much is gonna cost him? Let's write this here. How much is gonna cost him? 15,000. If you want to buy the shares, 100 shares is gonna cost them how much? 15,000. You with me? The share is traded for 150. If you want to buy 100 shares, it's going to cost them 15,000. He said, I don't have 15,000. He doesn't have 15,000. So we're going to go with the assumption that he doesn't have the 15,000, and we're going to visit it again. Well, let's say he bought an option for 1 month to buy these shares at 160. Keep in mind they today traded for 150, right? They're not at 160 yet. Okay, and this is for 1 month. Okay, what happened in that 1 month? Possibility. Let's say the first possibility, the share price shot within 1 month to 200. Big extreme. Okay, in 1 month there was a big news, big thing, and the price become 200. With me so far? He's gonna knock on the door. It's not on anything, it's an exchange, right? He said, by the way, remember, you have a contract with me that you're going to sell me the shares at what price? At what price, guys? 160. This is with CAD, right here. This is with CAD. This was the strike price. Said at any time they reach 160, they exceed or they go anywhere, I can only pay 160. So he's gonna pay 160 for the stocks. And what did he do? He take it for 160 and sell it immediately for how much? 200. He's dead beat. He only have $500. He doesn't have money to buy the option in this scenario. He's speculating. He's only speculating on a direction of belief the stock price is going to go up. So he give the 500. He was right. The stock price now traded at 200, and he bought it at 160 from this guy and immediately sold it for 200. So how much he ended up making? Okay, he got it for 160.
$3,500.
Right. And how is the 3,500 came from? He made $4,000 on the trade, and it cost him $500 to buy, though he ended up making $3,500 profit. You guys with me? It's a simple story. He ended up making $3,500. How much did he invest? And how much he made? What is his return on his investment? Can you do it? In percentage. How much? Yeah, 700. Because you take 3,500, you divide it by 500, is 7. You multiply it by 100, he makes 700% return. 3,500 on 500, you cross equals 7. You multiply it by 100, he ends up making 700% return on his investment. You guys with me? Now, it's such a beautiful investment. Do you agree? Okay. Oh, there is another possibility. Brownian motion. He started here. The price went up to 159. And he getting excited and he start watching the screen. And boom, 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 boom. And ended at 130. You know what ended? Nothing. It ended just for the sake of the story, so he can continue to be pissed off. It ended at 159. Within 3 months, it ended at 159. He has the right to exercise at 160. Will he exercise? No, because it's not going to make sense that I pay you 160 for something on the market for 159. You with me so far? So what happened to him? He just kissed his $500 goodbye after 1 month. So how much he got to lose? His entire premium, which is $500. Because option has what they call a time decay. Every day it passes by, the value for option erodes. And after 1 month, he has nothing. He lost the $500. You with me so far? We're good with the story?
Can you explain where you got the 4,000 figure from before? I know it's backtracking
Yeah.
a little, but that's.
No, it's okay. No worries. Okay. So here, we said the price reached 200 in the market, right? And he has the right to buy it at 160. So he knocked on his door and said, sell it to me for 160. No knocking, no doors. This is all on the trade. So he got it for 160 and immediately pushed the button to sell it back for 200.
Okay, I get it.
So he got $40 per share. He has 100 shares to make 4,000.
Thank you.
Yes.
Just a question of like the concept. So because the price fell from 160 to.
So then we're talking about the second story, the second scenario.
Yes.
Yes. Okay.
So because the price fell from 160 to 159, he's going to lose the $500.
He's not going to exercise.
Okay, but I'm just trying to think like.
Yeah. Let me explain one
Lost
thing.
like the $500.
He just lost the $500, completely gone.
Okay,
Because see, the $500 give him the right to exercise anytime within 1 month. You remember our story here?
right,
Only within that 1 month, he can exercise anytime. But the price never surpasses the 160, which is the exercise right. Because every time he's gonna knock on Freddie's door, Freddie has to go, give me 160. If you knock on Freddie's door and the price is 159, Freddie's gonna laugh, ha ha, yeah, man, take it for 160 and pay the extra dollar for each share. Right? He's not gonna do that. You good in the back? Good?
Yeah.
Okay.
Can you like outweigh how much you could lose by buying both, like calls and puts?
Yeah, we're gonna get to those strategy. Be patient. Yeah, we're gonna play in that space a lot, but we need to build the momentum. From butterfly to strangle to whatever your heart desires, to count doors to whatever your heart desires. Okay, but before we get there, follow the story. I want again, follow the story. So the other option, I just want to show you that option are powerful tools. They have a magnification effect. This guy, how much money he made on this trade? 700% return, right? You guys know where I got 700 from? 700% return. He invested 500, he ended up with 3,500, seven folds, 700%. You want to do it mathematically, you divide 3,500 by 500 is 7, you multiply times 100, it becomes 700. The other possibility, and assume this is a possibility, that he want to invest, that he want to buy the shares outright without going through the options. He just want to, he is bullish, he think Apple's is gonna go up and he want to buy the shares. And assume that he has the $15,000. So the guy is gonna go to the marketplace here and he purchased the share 100 shares for 15,000. Assume the first scenario happened and it becomes at 200. What will happen then? End up making how much? How much it's gonna make, guys? The price, forget about options, just regular stocks, it's gonna make $5,000. You with me? It started with 150, now it's 200, he owns 100 shares, it's gonna make $5,000. Yes? $5,000. How much he invest to make this money? 15,000. You guys with me? What is the return on his investment? 33%. Thank you. The return on his investment is 33%. In the second situation, the story, the return on his investment here was how much? Which one is bigger, 700% or 33%? Which one is bigger, finance guys? I'm losing you. You need chocolate or coffee? Or both? Which one is more? 700. So now we see the options and the derivative has such a magnification effect. You can actually make a lot of money with a little money. Equally sad, you could kiss your 500 goodbye within the end of the period. Assuming the second scenario happened and it drops to 150. Did we say 150? How much you said it can drop to? Yeah, 159, right? It drops to 159. Nothing happened. He actually made $9 per share. He made $900 because he bought at 150. Assume even the share price goes to 140. Right? Nothing happened. You own the shares. You're not under time constraint because options have a limited time constraint. You must act within that period of time. Owning the share, you can hold it for a year, for 6 months, for 9 years. Who cares? As long as you can. Are we good? Okay, I think we're gonna take a break because it seems like you guys need a little bit break.